Welcome to a new deep dive on the Gap Advisors Ind AS Clinic. We're dissecting a really specific real-world accounting observation today.
Yeah, a really fascinating one.
Right. And it's extracted directly from the published Ind AS financial statements of an actual listed company.
Exactly. It's not just a theory.
But before we jump into the deep end, let's establish a baseline for our discussion today. We are operating within the standard April 1st to March 31st financial reporting period.
Right. And we'll be using the Indian rupee, the INR, as our functional and presentation currency.
Which means any other currency we mentioned today would be considered a foreign currency.
Perfect. So we also need to establish where this intelligence actually originated.
Right, because we didn't just invent this scenario.
No, not at all. The observation we're analyzing today comes directly from the 22nd edition of the Gap Advisors Task Weekly newsletter.
Oh, wow.
Yeah, it's authored by C.A. Manish C. Iyer, the director of Gap Advisors. They recently published this on LinkedIn, where, they independently review financial statements.
And they found something pretty alarming this time.
They really did. And just a quick note, there are actually over 230 editions published to date. If you are on LinkedIn, I highly encourage you to subscribe for free.
Definitely.
But before we get into the mechanics of this alarming find, a standard disclaimer applies here.
Always necessary.
Right. The views expressed in this deep dive are the personal views of the author, and they are not binding.
So do your own homework.
Exactly. We are exploring interpretations of complex accounting frameworks, so you should always seek the help of an expert before taking or, refraining from taking any action based on our discussion today.
Okay, so let's get into the hook. Why should you, the listener, care about this? I mean, if you're an average retail investor or even like a portfolio manager allocating capital across listed companies, you are constantly looking at profitability metrics.
Oh, constantly. It's all about the numbers.
Right. You check the earnings per share, you look at the net profit margins, and you base your buy, hold, or sell decisions on those exact numbers.
And the underlying assumption there is that those numbers are an objective reality.
Exactly. But when we look at the mechanics of Ind AS 16...
Which governs property, plant, and equipment, yeah.
Right. When we look at that, we see how a single sentence in a company's accounting policies can, artificially engineer those profit metrics.
It's wild. The distortion usually happens through depreciation.
Walk us through that.
Well, for asset-heavy industries, think manufacturing, aviation, telecommunications, property, plant, and equipment is the heaviest anchor on the balance sheet.
Sure.
And depreciation is the mechanism that systematically recognizes the cost of those massive assets over their useful lives. It's an expense.
So it hits the profit and loss statement directly.
Directly. So if a company's management finds a, let's say, creative interpretation of the rules to pause or stop that depreciation expense, their reported profits will instantly spike.
Wait, just from pausing a paper expense?
Yes. The company suddenly looks highly efficient, the EPS jumps, and the market might reward them with a higher valuation.
Which is a complete mirage if the underlying economic reality hasn't actually changed.
Exactly.
So investors end up allocating capital based on a manipulated bottom line. And that brings us to the specific observation extracted by Gap Advisors.
Like the Suwamoto review.
Yeah, explain that Suwamoto part really quick.
So it means they downloaded the public financials of this listed company on their own initiative. Nobody asked them to do it. They just analyzed the policies themselves.
And in those published financials, the company stated a very specific policy regarding Ind AS 16.
They did?
They wrote that they ceased depreciating an item of property, plant, and equipment when the item is, quote, retired from active use and is held for disposal.
Retired from active use and is held for disposal. That is the exact phrasing we need to tear apart today.
Okay, let's play devil's advocate for the company's finance team for a second, because on a superficial level, this policy sounds entirely pragmatic, right?
I suppose it does, to a layperson.
Let me use a relatable real-world comparison. If I put my old laptop in the closet because I just bought a brand new one, I'm not using it.
Right.
So why should I account for its wear and tear? It's literally just sitting in the dark.
It sounds logical on the surface. But wait, even sitting in that closet, what's happening to the laptop?
Well, I guess the battery's still degrading.
Exactly. And the tech itself is becoming obsolete every single month you leave it in there.
Oh, so the value is dropping regardless of whether I turn it on?
Yes.
Yeah.
Doesn't your accounting have to reflect that reality? The closet theory is exactly why this company's policy violates Ind AS 16.
So depreciation isn't just about physical friction.
Not at all. That is a fundamental misconception. The framework does not view depreciation solely as a measure of physical wear and tear.
Then what is it?
It's the systematic allocation of the depreciable amount of an asset over its useful life. It captures the consumption of the asset's economic benefits.
Okay, but if a machine is turned off, what economic benefits are being consumed?
Time and technological obsolescence. Like, imagine a massive commercial printing press sitting idle on a factory floor. The rubber seals are drying out, the lubricants are settling,
Right.
and more importantly, competitors are releasing better, faster machines. The commercial value of that idled press is plummeting.
So if they try to sell it a year from now, they'll get way less cash.
Exactly. That loss of value is a real economic cost to the business. You cannot just freeze time by turning off the power switch.
The clock never stops just because management changes its mind.
It really doesn't.
So to prove why the company is wrong, let's open up the actual rulebook. Specifically, paragraph 55 of IND AS 16. This is basically the start and stop clock.
Right. Paragraph 55 is the authoritative text here.
Let's look at the starting trigger first. The rule says depreciation begins when the asset is, quote, available for use.
Available for use. Yeah, that's the critical threshold.
The text says, i.e., when it is in the location and condition necessary for it to be capable of operating in the manner intended by management.
Right. It separates the installation phase from the operational phase.
Let's test the boundaries of that. Because capable of operating is an interesting phrase.
It is.
Suppose an automotive factory installs a massive robotic welding line, like huge machines.
Okay.
They bolt the robots to the floor on, say, March 25th. They calibrate the software, run some test welds, everything works. But management decides, you know what? We aren't going to flip the on switch for commercial production until April 5th.
Because of a supply chain issue or something.
Yeah, maybe they just don't have the steel yet. So when does the depreciation actually start? March 25th or April 5th?
It starts on March 25th, immediately.
Really? Even with 0 cars being built?
Yes. The standard requires us to look at the capability of the asset itself, not the external dependencies or the commercial timing decisions made by management.
So the capability to operate is what triggers the accounting.
Exactly. The robotic line is in the location and the condition necessary to operate. The fact that they don't have steel is an operational failure, not an accounting delay.
That makes sense. It prevents companies from keeping massive capital expenditures in a perpetual work-in-progress state just to avoid the expense.
Precisely. You can't just hide depreciation because your supply chain is a mess.
Okay, so the starting line is absolute. Now let's look at the finish line. When does the clock actually stop?
Paragraph 55 has very exact conditions for this.
It says it stops at the earlier of 2 specific dates. First, when the asset is classified as held for sale under IND AS 105, or second, the date the asset is derecognized.
Right. Derecognition basically means a complete removal from the balance sheet, like it's sold, scrapped, or destroyed.
So until you meet the strict criteria of IND AS 105, or you literally get rid of it, the depreciation must continue.
Yes. And the standard actually zeroes in on the smoking gun in the very next sentence. It explicitly states, therefore, depreciation does not cease when the asset becomes idle or is retired from active use unless the asset is fully depreciated.
Wow. Unless the asset is fully depreciated, that leaves 0 room for interpretation.
0. The standard setters specifically targeted this concept of idle or retired assets because, historically, this was a massive loophole.
Oh, I can imagine.
Yeah, companies would routinely sideline underperforming machinery, declare them retired, and instantly boost their margins.
By hiding the depreciation expense.
Exactly.
Yeah.
And AS 16 forces companies to acknowledge the ongoing holding costs of those bad capital allocation decisions.
So this listed company cannot simply move a machine to the corner of a warehouse, call it retired, and stop depreciating it.
They absolutely cannot. Their blanket policy systematically understated their expenses, which of course overstates their operating profits.
But wait, I'm looking at the end of paragraph 55, and I notice a tiny fascinating exception hidden down here regarding usage methods.
Ah, yes, the usage method exception.
It says, however, under usage methods of depreciation, the depreciation charge can be 0 while there is no production. Can you unpack that for us?
Sure. This is structurally fascinating, but I'll tell you right now, it provides no cover for this company's policy.
Why not?
To understand why, we have to differentiate between time-based depreciation and usage-based depreciation.
Like straight line versus units of production.
Correct. So most assets use straight line. An office building loses value over time, whether it's full of people or totally empty.
Right. Time and the elements are destroying it.
Exactly. but certain highly specialized assets are consumed almost entirely by physical friction.
Give us an illustrative example.
Okay, picture a heavy stamping press in a car factory, and it is rated by the manufacturer to produce exactly 1 million car doors.
Okay, 1 million doors.
Its entire economic life is measured strictly in units produced, not years. If the factory shuts down for a whole year and produces 0 doors, the press isn't losing its capacity to make those million doors.
Because there's no friction happening.
Right, so under a strict usage method, the depreciation charge for that idle year is legally and logically 0.
That makes perfect economic sense. So the listed company in our observation could have a 0 depreciation charge.
But only if they were actually using a usage method. And their published policy didn't say that. It stated a blanket rule that they cease depreciating when an item is retired from active use.
They tied the stoppage to the management's decision to retire it, not to a usage-based calculation.
Exactly. You cannot mix the triggers. You can't apply a retirement-based stoppage to standard time-based assets.
Okay, that completely dismantles their first offense. But what about the second half of their policy? They claim the assets were retired from active use, and D is held for disposal.
Right, the held for disposal defense.
Does appending that phrase push the asset into that in AS 105 held for sale category we mentioned earlier?
This is where Gap Advisors' deductive reasoning is just brilliant. We can prove that retired and held for sale are not the same thing by looking at paragraph 79C of IND AS 16.
What does 79C say?
It encourages entities to disclose the carrying amount of PPE retired from active use and not classified as held for sale.
Wait, retired from active use and not classified as held for sale.
Exactly.
Why is this specific disclosure so important to our case?
Because it's the ultimate proof. If retiring an asset and intending to dispose of it automatically made it held for sale, then paragraph 79C would be structurally impossible.
It wouldn't need to exist.
Right. It acknowledges that you can have an asset permanently retired, gathering dust, that completely fails to meet the criteria for held for sale.
So what actually are the criteria for IND AS 105? Why is it so hard to just classify an idle machine as held for sale?
Because IND AS 105 requires strict, proactive criteria. It's not just abandoning an asset or writing an internal memo. The asset must be actively marketed at a reasonable price.
Actively marketed.
Yes, and the sale must be highly probable within 1 year.
Within a year. That's incredibly tight for specialized industrial equipment.
It is. If you just leave a machine bolted to the floor and say, we intend to sell this eventually, that fails NAS 105 completely.
And so the depreciation clock keeps ticking.
It has to keep ticking.
Okay, so they failed on the depreciation timeline. But Gap Advisors highlighted another major error in the company's reporting, right? Something to do with the valuation.
Yes, the measurement basis. And this shows a fundamental misunderstanding of the framework.
Break down the rules for us. When an asset actually does legitimately meet all those brutal hurdles and is officially classified as held for sale under IND AS 105, what happens?
Well, the depreciation stops, but the measurement rules change. It must be measured at the lower of its carrying amount and its fair value less costs to sell.
Fair value less cost to sell. That's the IND AS 105 standard.
Yes.
But the source material notes that this company somehow measured the asset at net realizable value, or NRV.
Right. And applying NRV to property, plant, and equipment is a massive structural error.
Explain to the listener why this terminology mix-up actually matters. Aren't fair value and net realizable value kind of the same thing?
Not at all. NRV is typically an inventory concept governed by IND AS 2.
Okay.
Inventory is the stuff you are in the business of selling to customers. NRV is an entity-specific measurement based on management's internal expectations of what they can sell those goods for in the ordinary course of business.
But a factory machine is an inventory.
Exactly. The company is not in the business of selling factory machines. It's a capital asset.
So they shouldn't use an inventory standard to value it.
Never. If it meets IND AS 105, it requires fair value. And fair value under IND AS 113 is a market participant-specific measurement.
Meaning it looks outward at the actual market, not inward at management's hopes and dreams.
Precisely. It ignores internal inefficiencies and demands a strict external validation of what a buyer would actually pay today.
By using NRV, the company proved they don't understand the difference between the goods they sell and the tools they use to make them.
It's a huge red flag regarding their compliance culture.
It really is. Now, having deconstructed all these errors, let's zoom out, because this isn't just an Indian accounting issue, is it?
No, not at all. This is a crucial point for our global listeners. While Gap Advisors' response is given under the IND AS framework, there is absolutely no difference between IND AS and IFRS for this specific topic.
Not at all.
None. The mechanics of Ind AS 16 and Ind AS 105 we just discussed apply uniformly to any entity following the IFRS framework anywhere in the world.
So entities following IFRS can apply this exact same logic.
Absolutely. The underlying economic reality doesn't change based on geography.
Let's talk about solutions and resources because, again, Gap advisors found this error independently in a published financial statement.
Right. Out the public domain for everyone to see.
Which is a nightmare scenario for any CFO.
Yeah.
So what is the actionable advice here to prevent this?
Companies really need to get their financial statements reviewed by Gap advisors before signing them.
Preemptive action.
Yes. It avoids these highly public errors. And for the investors listening, you can use these kinds of reviews to make proper buying, holding, or selling decisions.
And how do they actually do that?
Well, companies can submit their financial statements in a near-to-publishing PDF format directly via email.
To what address?
To info@gapadvisors.com. That's info@gapadvisors.com.
That is such a vital layer of protection. But I also want to talk about the auditors, because I empathize with auditors who must document exactly how they address these tricky Ind AS applications.
Oh, the pressure on auditors is immense, especially when they have to challenge a client on a policy like retired from active use.
Right. The client is going to push back hard.
They always do. So the auditor needs unassailable documentation.
And that's where the issue repository on gapadvisors.com comes in?
It is an incredible tool. The repository hosts over 4,500 issues and responses on Ind AS and Indian GAAP.
4,500 plus.
Yes, it covers all these obscure edge cases,
Yeah.
and any person can register for free.
Wow, free registration.
Yeah. You register, submit your specific issues on Ind AS or Indian GAAP, and you get a detailed response delivered directly to your inbox.
I can imagine for an auditor working late on a Friday trying to finalize working papers, getting that expert response straight to their inbox is a lifesaver.
It gives them the objective proof they need to stand their ground.
But what if an email isn't enough? What if a listener is wrestling with a highly specific, complex Ind AS or IFRS issue that requires real dialogue?
For complex structural issues, you really need an interactive consultation.
And they can get that too, right?
Yes, you can book a 1-on-1 consultation directly with the author of the newsletter on his topmate.io page.
That's C.A. Manish C. Iyer.
Exactly. You book time on his topmate.io page, bring your specific issues, and get tailored guidance so you don't fall into the compliance traps we've talked about today.
That is an amazing resource.
Yeah.
All right, as we wrap up this deep dive, let's briefly recap. We've seen how a simple, seemingly innocent phrase like retired from active use can completely unravel a company's compliance with Ind AS 16.
Resulting in understated expenses, overstated profits, and misvalued assets on the balance sheet.
It's a house of cards. But before we sign off, I know you have a final, provocative thought to leave the listener with, something that flips this whole scenario on its head.
I do. We've spent this whole time analyzing the dangers of companies artificially stopping the depreciation clock early. But what happens when the clock legitimately runs out, but the asset refuses to die?
Oh, like a fully depreciated asset that's still working.
Exactly. Think about a company that has fully depreciated its primary manufacturing equipment. The carrying value is zero. But they maintained it perfectly, so they are still actively using it to generate revenue.
Wait, so there's no depreciation expense hitting the P&L anymore?
None. They were getting free production from an accounting standpoint.
So their reported profit margins must look incredible.
They look unbeatable. Their return on assets metric gets totally distorted because the asset base is mathematically zero, but the profits are rolling in.
But what is that telling you as an investor? What is the hidden trap?
The trap is the looming massive cost of capital replacement. That machine will eventually break down. And when it does, the company will have to spend massive amounts of cash on a new one. The moment they turn that new machine on, a huge new depreciation expense hits the P&L, and those spectacular margins vanish overnight.
Wow. So if you don't understand the aging profile of their asset base, you're going to be caught holding the bag when reality hits.
Exactly. It's just another reason why you have to read the policies, not just the top-line numbers.
Such a powerful takeaway. Well, we want to thank you, the audience, for your time and dedication to learning these critical mechanics with us today.
Absolutely. Thanks for tuning in.
We kindly request that you follow or subscribe to the Cap Advisors Ind AS Clinic podcasts. You can find us on Spotify, Amazon Music, or YouTube, whichever platform you prefer to listen on.
Hitting that subscribe button really helps us out.
And we also strongly encourage you to follow the Gap Advisors Ind AS Clinic channel on WhatsApp.
That is the best way to get real-time updates.
Yeah, you get updates on all the new videos, podcasts, newsletters, new issues responded to in the repository, and critical alerts on new standards issued.
It keeps you right on the cutting edge.
Finally, we request that you share this deep dive among your contacts, your colleagues, your audit and finance teams, and especially with students pursuing their CA course.
Yes, spread the knowledge. It's so vital.
Helping to spread the vital knowledge of Indian accounting standards is how we all succeed. Thank you again, and we will catch you on the next deep dive.